The stock market will crash during your retirement. I don't know when, neither does anyone else, but I do know what you should do when it happens. Now, there are loads of people online saying that the stock market is going to crash and you need to flee to cash or gold or some other asset like that. And, well, they are correct that it will crash. In 2023, a lot of them were saying the exact same thing. And if the market goes down 50% from where we are today, in 2023, when the market was around 4,000 during a decent amount of the year, if you crashed 50% from 7,500 where we are today, that's 3,750, only 250 points below 4,000. And you've been collecting a dividend over that time period, so you would have been better off holding the S&P 500 over that time period. Now, one of the reasons why this is really important for retirees is sequence of returns risk. The idea that if your portfolio crashes by 50% in year one of your retirement, that your withdrawals for your entire retirement are damaged, and you could run out of money a lot sooner than you had expected because of that. Now, there are 4 pillars of what you should do to prepare for and in a crash. The first is keep several years of expenses. You have to figure out exactly what it should be for your specific situation, but 2 to 5 years of expenses in cash and short-term bonds so that you never have to sell equities in a down market. And the second is use the bucket system. Have different time periods bucketed, like over 10 years, let's say, is in stocks. 5 to 10 years, the funds that you're going to use in that time frame are in longer term bonds and maybe a lot more conservative investments. Like, you could use income yielding investments, dividend stocks, and a lot of other stuff for that bucket. And then the third bucket is what we talked earlier, the cash bucket. For the first 2 to 5 years, roughly, you should have that money in cash. And the third pillar is flexible spending rules. Now, if you have the money, and if it doesn't affect your retirement plan, then spend all you want in a down market. But it could make sense potentially to invest more money in the market in a down market and let your withdrawals decline a little bit. Now, obviously, you don't want to let this go too far, because if that's in the early years of your retirement, that's when you can actually do stuff. So you could end up sacrificing the golden years of your retirement and get nothing back except more money, which ultimately, what's the point of money? To buy your time back, and you can't get more time. Now, the fourth is Roth conversion positioning. Crashes are usually actually a buying opportunity for conversions because the value has gone down. If, for instance, you convert $100,000 today, you're going to have to pay taxes on $100,000 if you transfer it to a Roth IRA from a traditional IRA. If there's a crash, it's $50K now. You only have to pay taxes on $50K. So this is a strategy that you can employ and just cut down a lot on your tax burden in retirement. And just briefly, panic selling locks in losses permanently. For instance, if you sold in 2009 at 600 points on the S&P, the S&P is at 7,000, roughly 7,500 today. That wasn't a good decision. If you sold in 2020, the S&P bounced right back, the government pumped loads of money into markets, and they powered way higher. Having a written plan and having someone to keep you honest and keep you going on that plan helps with this a lot. And the goal isn't to predict a crash, it's to make the crash irrelevant to your plan and your retirement. If you're interested in more content like this, please subscribe. And if you're interested in investment management services, we're a registered RIA in Southern New Hampshire. You can see our contact information in the description. Thanks for watching.